you as the owner or the leader of the business needs to make sure that the company continues to perform, and your day job isn't overshadowed by the transaction itself.
It sounds like you named off a lot of fairly sophisticated buyers, though. So the seller has to have a good team.
Business owners should be thinking about selling their business even as early as the day they started.
Welcome to our show. Today I have with us one of my partners at BGM, Blake Johnson. Blake is the president of a BGM company, SealedBid, which works with mergers and acquisitions. And I thought it would be fun to have Blake on today to talk more about what happens when business owners decide enough's enough and I need to get out. So with that, I'd like to introduce Blake. Welcome to the show, Blake.
Yeah, thanks, John. Appreciate being here and look forward to a good discussion.
Yeah, let's start with the easy stuff. There is a lot of discussion in the day about exit planning versus mergers and acquisitions. Can you describe for us what the difference is between those things? Because they are very different.
Yeah, I think, as SealedBid, where we position ourselves in the marketplace as, one of the execution type entities when a business owner is committed to a sale process. So, business broker, investment bank, typical, terminology for firms like ours, business intermediary, facilitator, where the succession planning piece comes into play is definitely with firms like ours and others that specialize in the planning process. So it's everything that business owners can do in advance to either set the table for a successful sale, ready their company to create options in a sale process, and otherwise, specifically in family or entrepreneur-led businesses, create a transition plan that will result in whatever goal those business owners are looking to accomplish.
You're the execution phase.
Yeah. Yep. So then once, the strategic team and the business owner has, put their plan in place, hopefully in advance, sometimes on very short notice, they would hire a firm like ours to package the company for sale, meaning initial diligence, questions, strategic opportunities, really building a sales piece around the strengths of the company that's, used in a confidential basis. And then, our job is to outreach to applicable prospective acquirers, whether they be strategic, financial, or other, to meet those owners' goal and ultimately drive that process to a successful transaction.
To that point, most people may think this process is a fairly fast process, but I think you and I both know that doesn't always happen. Talk about the time frame from two perspectives. One is what actually has to happen and how long that takes. But secondly, when should a business owner be starting to think about this? Because I think that's where people kind of, in my opinion, are a little off base. They probably need to think about it sooner than they actually do.
Yeah. I think any advisor, whether they be in the investment banking side or CPA or wealth or attorney, they're going to say business owners should be thinking about selling their business even as early as the day they started, thinking about the process, what it's going to take to drive value. But, in a more practical sense, we say, 2 to 3 to 5 years in advance of, a desired timeline. Obviously, life happens, situation change. But, in an ideal scenario, business owners are doing the things to create either value or continuity in a transaction well in advance of, pulling the trigger in that effort. And, to your first part of your question, once you have made the decision, hey, I'm ready to sell, I'm ready to engage advisors to make a transaction happen. Yes, you hear stories about unsolicited offers that, can get done in a shorter time frame. But even, at that offer stage in today's world, you're looking at 60 to 90 days of due diligence, legal drafting, negotiation, if it still needs to be accomplished. And so, a whole process can take 6 months to a year, depending on how many buyers you approach in again, that outreach phase, how many discussions and interest, how much interest there is. It's routine for us to, generate 6, 7, 12 offers, and it'll take a month just to get through to, who is the correct party. And so allowing yourself to have that timeline and understand that, there'll be a lift alongside the day job of operating and hopefully, a positive direction and trend of your existing business. It's definitely an undertaking that, planning and time in advance helps make go smoothly.
Step back to that comment you made about they should be thinking about this 2, 3, 4, 5 years early. When they start to think about it from that perspective, they're probably going to have a lot of issues in their business they got to fix to make it more valuable. Can you talk about the 2, 3, 4 drivers that they should fix typically that make it more valuable if they have that kind of time?
Yeah. And I'll even change the lens a little bit because, we work, again, call it lower middle market, typically companies that are below 100 million of top line revenue, family held or entrepreneur led businesses versus those run, more in the financial, whether it be private equity or larger corporate entities. Fix is a word that sometimes, gets business owners, hair up. It's not necessarily fixing, but if you look at, a business transaction as an investment, as a financial decision from a buyer's lens, what business owners can do 2, 3, 5 years in advance is really start to de-risk that transaction, which ultimately will drive value. Yes. There's some direct things like making sure that the owners of the business have a strong management team that can support the business on a go forward basis. It's often that a business owner will come to us and say, well, I want to be done the day of closing. And that business owner is responsible for, substantial or even all the book of business of the company. And so thinking about empowering your team, maybe even augmenting and improving your team, so that you as owners can step back from the business is a major threshold for entrepreneurs, as well as, just identifying what is driving revenue and profitability. Is there customer concentration? Is there reliance on a very delicate supplier base? Those types of analysis and considerations, again, using a buyer's lens on how confident am I that this revenue stream and this profitability will continue into the future, are all big pieces that owners can get, ahead of well in advance of the actual transaction process.
To that point, let's say they have some things like that they need to work on. I'm not asking for a hard number, but generally, how much does that improve their actual sale price then?
It can be quite substantive. And, we've seen businesses that have a couple large, very attractive customers. And, upon first meeting, it takes a minute for the owners to understand that, yes, you've got blue chip customers and just doing business with that entity is a positive thing. But if they have a 90-day out or a 30-day out or no written agreement that's supporting that business, it's very much viewed by buyers in that lens, in that it's, substantively risky, especially if there's somebody key that's controlling the relationship that may not continue. So getting in front of, that example specifically, you look at specific agreements that can or cannot be put in place, in writing. You look at servicing customers differently, so there's not one key relationship that's managing the entity, whether it be on your side or the customer's side. You look at diversification in a totally different way. So instead of accepting more business at lower margin from your top customer, maybe your emphasis to your team is to diversify to, higher margin, smaller pieces of business across a wider portfolio of customers. And that takes time, obviously, to flow through. And again, ultimately, to your question, what the value outcomes can be is, I've seen swings of several multiples. In our world, we use a multiple of earnings typically for value, and the discount factor for customer concentration can be quite significant.
So you've touched upon the front end a little bit. It sounds like people should get you involved a lot sooner than they do.
Yeah. And, I would say definitely, your transaction advisor is a great resource, but we generally recommend that business owners start to meet with an entire transaction team. So somebody like yourself, John, they're definitely their legal team. Business owners often have a great corporate, attorney that they've maybe have grown the business with that may or may not have transaction expertise, but likely has access to other individuals via their firm or their network, their CPA, their lenders to the extent that they have, debt. All of those professions and strategic advisors to business owners have a seat at that table years in advance of that decision, because as I'm sure you've covered in presentations, there's a lot that can be done to either drive value or make sure you keep more of the cash in a transaction.
Yeah. One thing that I've seen, I think you'd agree with, is sometimes those financial advisors are either a great help or we get in the way. And you smile, right? The answer to that really is we help if we can help the end client understand what the sales price, what they kind of need to retire on, so that they don't get overly excited and try to run the price up. The other side is we could also help them set a price in their head that's so high they can't ever get it.
Yes. Yeah.
I think you'd agree with that.
It's often that, we meet with business owners who know exactly what their company's worth because it's the number that their wealth advisor told them they need to retire on. So yes, I think, there is that dynamic. And I think that's why having the team, even meeting collectively in at appropriate points in time, will help align everyone into what is ultimately, the goal. Like you said, it's the goal of your profession and definitely, those that I've mentioned, to ultimately create success for those business owners and clients. And, I think everybody brings their unique perspective and expertise to creating that success.
If I could encourage any of our listeners to do anything, it's get everyone in the room for 2 hours when you first think about it. I know a lot of people think, I don't want to spend the money on pulling everyone together, but it's the smart thing to do.
Yes, definitely.
So let's say they've engaged you and you're to that point where you're starting to look at some offers. You and I have had this conversation a little bit, but there's two pieces to every transaction. And I'll just run through this quick, but one is price and the second is terms. And you and I have had this conversation. I think most people come to the table wanting the highest price they can get. If I were at the table, I'd want terms.
Sure.
Why don't you unpack that a little bit? Because I think you and I kind of agree on this, but
yeah, we use the term, the phrase, cash is king. So when you're looking at a business transaction, yes, price is often where business owners' heads start. Is, I want X amount for my company, but as I briefly noted, in a competitive process, done confidentially to a variety of buyer types, and ultimately, done well where there's multiple interested parties, it's routine that we see the highest purchase price offer not selected as the one to move forward with. So yes, when it comes to terms, businesses trade obviously for cash or cash at closing, for stock consideration and a purchaser that, is immediate, but they're very frequent that businesses will also trade with sometimes seller notes or seller paper or seller financing. There's times where there'll be structure based on business performance going forward. And each of those categories can have several different nuances to them. It can be a note that's, extended with a balloon. It can be an earnout that is, based on lofty goals, or it can be an earn-out based on, very achievable metrics, as opposed to, true things that an exiting owner can't control. And so, we often advise sellers that, what for sure is the cash at closing that you receive, you've received. So if to the extent you start to agree to trying to achieve a larger total sale price by introducing structure, it's definitely a room for pause and consideration.
Yeah. To that point, what are 2 or 3 terms that you always advocate for that you really like that are the most helpful for people to think about?
Outside of a totally cash deal, which, we've been fortunate enough through competition to drive, numerous transactions that way. We often look at a strategic approach where sellers can maximize value by being acquired by a strategic, or, a strategic can be a competitor, but it could also be a complementary company in the same space or same vertical market. And oftentimes with some structure in an acquire, in that case, you can get a note from a larger entity, from a publicly traded company or the like. And, those do become, extremely highly successful as far as collection. You can typically get better than market interest rate terms. And so, when I look at kind of secrets to driving value and structure, it's, seller notes aren't great. You're not getting the cash at closing, but who's signing that note and what's the probability that, things go smoothly to collect? Other things in structure that we often spend quite a bit of time on is, it doesn't show up in purchase price and how that's divided, but it shows up in cash that the selling group gets to keep. And that's working capital. So businesses typically trade with what's called a, working capital amount, often calculated by a normalized average or a target based on the analysis of each side. But what that means is, the seller keeps their cash, they're responsible for their debt, but they also give with the transaction the accounts receivable, inventory, and the buyer assumes the current liabilities. And often a business owner who has started a company or has grown a family business is operating without debt, is operating, typically a little looser in their use of cash or controls on inventory. And then when they start to do the analysis on what's really going with the business, and we obviously do it quite a bit in advance as well, there's real dollars there. So back to your question about things to prepare in advance, if you can start to really scrutinize those numbers with your financial advisors, it's ultimately putting more cash in your pocket at the closing date by leaving less in the business. And it has to work. The business has to function. It will be scrutinized, but that is a value lever outside of purchase price that we've seen, sometimes be, quite substantial.
So stepping back a second, when in a deal, if a buyer's interested, they'll give you a letter of intent and you guys start going down the road with due diligence. What are a couple things that the business owner does to blow up deals?
Yeah.
Or to, kind of just screw up the whole thing because of, for whatever reason, it could be emotions, could be anything.
Yeah, there's definitely road bumps in the process. So there's things that can totally terminate, a proposed transaction between two parties. There's things that can cause renegotiation. And really what, a business owner needs to focus on when they're to that stage is, you've assembled a team of advisors to assist you in that process. You as the owner or the, leader of the business needs to make sure that the company continues to perform and, your day job isn't overshadowed by the transaction itself. The other piece of a deal, that's not obvious, like an error in financials or a massive change in the performance of the business, is just time. You need to be prepared to get through this process, deliver reports quickly, again, alongside your team, so that the momentum of the transaction continues. We're working on, a couple different deals right now that have extended, instead of 90 days from letter of intent to closing, it's well beyond that. And in one case, the performance of the company for no fault of, the owner has been impacted by macroeconomic events, by local events. And, those have created challenges along the way that could have, the deal could have been done before any of that occurred. So, emotions, as you called out, are always going to be there. We try to make sure some of those thresholds are crossed in advance of going to market. But it's an emotional and it's a large, transaction and an event in anyone's life. And so, those things need to be at the forefront and managed alongside all the finance as well.
You mentioned the speed issue, and I can appreciate that. I've seen deals fall apart because they lose momentum more often than not. It's always amazing to me. When you look at it from the perspective of the owner after the fact, is there anything that they say after the fact where they're like, I wish I would have done something different? Are there things that they know they screwed up even 5 years earlier that they could have done different? Where you're like, that's a key learning. Like, I should share that with my next deal.
Yeah. I think some of it is fleshed out in the process, and you may not get those insights until you're really, trying to get a deal across the finish line. One of them I can think of is, considering your lending partners and any financing structures you have in place, and how those relationships and whatever vehicles are in place will react or trigger during a transaction. Some of that can be mitigated quite easily. Some of it, is totally dependent on what the buyer's intent and purchase structure looks like. But definitely have seen, sellers get through everything and realize there was a quite easier path. The other piece would be really looking at that management team. And, if you're going to agree as a business owner to a transaction where you're helping in transition and you've promoted or elevated in the process team members, that may, drive value to you post close by their performance. Sometimes, I think there's rose colored glasses on, who's truly ready to step up into those seats. And really, we always promote, if we're going to take that lens to market, that those individuals are a part of the process and have been performing the duties we're presenting at the company prior to the sale.
You bring up an interesting point, though. Sales happen differently. Sometimes they're internal to a team that is already there. Sometimes they're external. Sometimes they're to private equity, whatever. Which ones are the most successful? What do you think you've seen in the past from that perspective?
That's a tough one because I think business owners' goals vary so much. If you told me that you had a business owner, acquaintance or client or friend that said, I want max value and that's all I care about, I'd say that's pretty unique. Most business owners, again, in the lower middle market, have some other driving factor in, what would be an ideal transaction or to complete their goals in a sale, whether that be, elevation of the team or continuing their company legacy. Or we even had a deal where, the business as itself stood well and was very much wanted, but that was in a smaller town with some brand new fancy real estate that was also owned by the business owner. And that business owner's goal was to have a buyer that purchased that real estate and therefore committed to that smaller community, as opposed to one that would lease for a period of years and likely move. And so, that goal reduced the value of the business. Now he made up with some of that value in the sale of the real estate, but it also reduced the buyer pool because there are, significant considerations from business acquirers to whether or not they're interested in real estate. It's viewed as a totally different investment. And I would say, more often than not, it's not desired to be purchased alongside the business. So when you say, what's the most successful outcome, I can highlight transactions like that one that preserved a legacy and empowered the management team in a small community. I can highlight, huge multiple deals where, we were way too conservative and their wealth advisor was way too conservative in what they needed. And now they've got too much money in retirement, right? But I think it's really about aligning as a business owner with your strategic advisor group on what truly is your ideal transaction and what components will make that come to fruition from the buyer's perspective. Obviously, more price is always going to be good, but there's often, other dynamics at play.
To that point, though, how do you have that discussion? I'm just curious more than anything.
Yeah.
Because it feels like sometimes an owner brings what I would call a deal killer to the table, to your point. Like, if you want to stay in the small town, you might have a whole lot fewer buyers.
Mm-hmm.
So how do you have that discussion with them?
Well, our firm, and I think, others like us, that we do valuation work. And I'd say some firms are better than others at including that conversation in value. It's more than just a corporate finance or a financial exercise when you come to, any method of valuation. It's really understanding the company alongside the numbers and that goal perspective alongside the numbers. So we try to initiate that even before engagement to make sure that we're presenting what would be reality. And generally speaking, a deal killer from our perspective should be known by everybody, well before you're receiving offers.
Interesting. One thing too that I wanted to bring up, because we're seeing this more and more in the marketplace, and I think you're the perfect guy to ask about this, is that more and more companies, even small deals, are wanting a quality of earnings report. Mm-hmm. Sometimes that rankles the owner a little bit, but could you just give us a brief description of what that is and why it's important, and when do you think it needs to be done for sure versus it's just a nice to have?
Yeah. Well, I think the emergence of the quality of earnings report, often abbreviated to Q of E, is largely driven by kind of a wholesale change in the diligence effort on the buy side of the table over the last 10 years. They've been common in larger transactions as part of lender requirements and other diligence requirements, but they've become more and more common in lower middle market deals. And to the extent now, people like myself, the sell side advisors, are recommending them in advance of going to market so that when you get through a process and you've selected a buyer and they hire their own financial diligence company to run this report, there's no surprises. And, to your question of what is it, I think concisely stated, it's a buy side, or historically had been a buy side diligence report driven by CPA firms and other financial advisors to, provide proof of performance on the historical financials. So, generally accepted accounting principles, revenue recognition, off balance sheet liabilities, true, earnings defense if there's adjustments and things like that. So it covers the full gamut to give confidence, ultimately, again, driven by sometimes lenders or investors in what's been demonstrated in the historical financials.
Have you ever seen a company do a QOV and decide not to sell and to fix things and then come back to the table?
Yes. I think, like I stated, the sell side QOV, either in a full fashion or in a piecemeal a la carte fashion, has become more and more common. And, I would say it's often done in, somewhat quick succession as far as if there's something identified that needs correcting. If there's something identified that's, more of a substantial lift, then yes, I think it ultimately the decision to delay a transaction process is going to be based on, the owner's appetite for that time window versus the, potential discount in value that would have been, otherwise attained. So I think they're a great tool. I think there's a great way to use them, as a small business in an a la carte fashion. Your financial advisor, that's hopefully helping you with your internal financials in either a compilation, review, or audit format will have, the insight to target analysis that will be, very directly tied to value. And when you generally run into this in the sale process is once you've selected your buyer. And so if a buyer brings in these material changes in your financials at what is the 11th hour, you're running out of leverage to negotiate. You've selected somebody, they found something, you've told all your other interested parties that you've chosen one party. And so getting ahead of that is just a very proactive negotiation tool as well.
Interesting. So you've been at this a long time.
Yeah. 16, 17 years. Yeah.
Yeah. What's one thing you wish you knew 10 or 15 years ago?
I try to learn every day, John. That's why it's nice to work with people like you. I think for me, there's kind of two facets of the job in the corporate finance, financial analysis, the stuff that you're learning all the time. I learned through a fire hose over the course of working with SealedBid, and had a great mentor in the founder, Jerry. But, I think where I've seen my skills and pieces where, I'm trying to shift my growth is in really the psychology of business owners, of entrepreneurs, of, really understanding the driving factors for the individuals that, I serve as my client. And, as you stated, a lot of deals have hurdles sometime in the process. Hopefully they don't, blow a deal up, but I will say, a lot of those hurdles are driven by emotions and reactions. And so, getting better and getting, kind of that psychology aspect more than the math or finance, has helped me. And, it's something I continue to work on.
It's interesting you'd say that, because when young people come to me now and ask about financial planning, I tell them to focus on that more than a lot of us coming out of school did. So that is interesting. So what have I, as we kind of close up shop here, what have I not asked? Is there anything I haven't asked? You're like, God, you really should know this stuff.
I think we've covered a lot of great topics. One of the areas that we haven't talked about is, what's happening with buyers right now. And, I would say it's continue, and again, there's been, in the last 5 years, there's been, tariff changes, there's been interest rate changes, there's been now wars and other macroeconomic or geopolitical events that impact businesses. But, what we haven't talked about is buyers. And right now, there is a substantial amount of activity on the buy side of M&A and the buy side of transactions, whether that be corporate entities that have devoted resources to growth through M&A as opposed to, just organic or net new greenfield growth. We've seen a lot of companies across segments with more reactive and, distilled interest with professionals to get deals done than in years past. And we've seen a huge growth in the financial buyer category. There's always been, a plethora of private equity groups. We're seeing now more family offices that are specifically choosing to do business M&A and other financial buyer categories that really, I think offer business owners and entrepreneurs less of the rigid, maybe stigmatized private equity model and more of a humanistic approach to the transaction, their team members, and the future of the business.
To that point, it sounds like you named off a lot of fairly sophisticated buyers, though. And so the seller has to have a good team.
Definitely. Yep. The buyer is going to bring sophistication to the transaction, whether it's them or it's their, who they hire to help them get the deal done. And as I stated, kind of related to the QV, it's more, diligence process is more robust, and there are more tools available even on the smaller transactions than ever before. And that's not going to change. It's going to continue to grow with the adoption of AI and other resources that are at people's fingertips. So I think as business owners, you have to have that same lens and approach when preparing your business.
Just because it's my lane a little bit, I'm going to ask the interest rate question. Have higher interest rates changed the buyer pool and or the price that people are getting?
I think the cost of capital and cost of debt, there's a lot of studies and papers on, the larger transactions and the ebbs and flows of, kind of the broader global M&A market or, North American market. I'll speak anecdotally from, our experience working with businesses, again, in that 100 million of revenue or less category. We haven't seen the pricing pressure created by rising interest rates. Generally speaking, the transactions in this size include a quite substantive piece of equity. They're not over levered, and therefore, the cost of that debt is somewhat absorbed in the whole cost of capital calculation by buyers. We're seeing more equity just in general come into transactions in this size because buyers are looking to buy and build as opposed to buy and flip or buy and slash. And we're in, that corporate buyer category, or the strategic buyer category, is largely using either an established piece of debt or balance sheet cash. And so therefore, is not impacted by, those interest rates in that specific transaction.
So since you brought it up, I can't leave it sit. You said there's more equity being used. What should sellers expect at this stage in 2026 for the percent of the deal in cash versus the percent of the deal in equity?
Yeah, I mean, it definitely depends, who the buyer is, what the metrics of the business are. You get into considerations about whether this is, a well collateralized, meaning, that there's a piece of debt that is matching collateralization against assets, or whether it's a cash flow lending situation. All of those will impact the bank's willingness to lend. It will impact subordinated lenders, SMEs lenders, secondary lenders' willingness to come in behind the senior and for how much. So it can vary, but, we're generally seeing proposals no lower than 25% and sometimes over 50% of the deal being in cash equity into the purchase. And a lot of that is driven by what the next purchase is for in what the buyer's roadmap, tends to be. If they're looking to buy a business and quickly grow it through additional acquisitions, if this is the platform or the first step in that process, leverage and the leverage ratios will be considered in a broader picture of what's to come.
Interesting. So typically less cash then.
More cash in that scenario.
More cash in that scenario?
Yeah, buy the first business at 50% and then look to leverage that cash flow as well as additional debt at a higher ratio into the next one.
Okay. Interesting. That's why I always ask, what haven't I asked about? Because I learned something. Well, as we close up here, why don't you tell us how, if people want to get a hold of you, they can get a hold of you?
Yeah. So SealedBid.com is our website. My email address is bjohnson, as in Blake Johnson, at SealedBid.com. And I'll make sure that, it's included in some of the materials for this distributed. But, I look forward to engaging any of your viewers in even initial conversations about that planning process. And if there's not something that myself or our firm can do, we'll be sure to point people in the right direction.
I appreciate that. And with that, I want to thank everyone for listening. As usual, if you want to see more of our content, go to bgm360.com and feel free to like this episode if you would. Have a great day.